3 years ago, Tesla was at $414 a share. It's now in the 160s. There's a lot to learn here, not just about if Tesla's a buy or not, which we will get to, but also about understanding hype, because there was a lot of hype around Tesla. And I want to make sure that you understand that hype eventually does fade, and Tesla is a great and recent example of that. This is our new channel, Everything Money 24/7. Do me a favor, if you like this video, please subscribe, because I want to make sure you see that we do a lot of great things on our channel about talking about individual companies, and this channel is dedicated to several videos per week about what's going on in the markets. So let's pull up Tesla here to show you exactly how that is going. Tesla today is down 3.26% to 165. Guys, look at this 5-year chart. It hit a high of 414 on November 4th, 2021. It has gone nowhere but here. And guess what, guys? If at this point right here, after Tesla just kept going up and up and up and up and up, if I had told you that 2.5 years later, Tesla would be down 60+%, what would you have said to me, Mo?
Well, everybody did say you're dumb.
They actually did say I was dumb. And by the way, I want you guys to keep in mind, I was wrong on Tesla all the way, like right here, completely wrong on Tesla. Why? I didn't properly factor in their growth rate. I didn't think a company could grow that fast. Now, the same point that's happened, I think people are wrong here. And in this area, I said, Tesla has the chance to be like those other big companies that didn't see all-time highs for 10, 20 years. Is that likely to happen? I don't know. Euphoria can happen. Look at NVIDIA. Just a year and change ago, it was at $100 a share, and it's gotten as high as $950. That just shows you how hype can just take things to insane amounts of levels. And I learned the hard way about that.
And Paul, think about the EV craze. I mean, it's not so much a craze anymore. You've seen Ford kind of pull out of it. A lot of foreign companies are starting to pull out of it. So the EV hype is not there anymore as far as like how you get a car to move.
And yeah, it's not necessarily pull out, but they're decreasing. I mean, look at Tesla. Today, Tesla announced 10% workforce, which is being laid off. Oof. That's 14,000 people. That's why the stock is down so much. And guess what, guys? Here's the crazy part. This is what I'm going to show you. You might sit there and say, well, yeah, but the financials suck from 414 to here. Well, let's take a look at that real quick.
It's funny you say that, because I took a peek before, and yeah, the financials have not gotten worse.
At all. Guys, in that year where Tesla had its all-time high, did revenue of $53.8 billion. Last year, 96.773. Does this look like a company that went from $414 a share down to $165? Mo, does that look like that kind of? By the way, in this time between here and here, it actually hit 103 or so, or 107.
Yeah. I mean, when I look at this, if you just showed me those two things, I would say, oh, this company is probably worth $750 a share now.
Exactly. And guys, we've seen this in the past. If you look at companies like Intel, Cisco, what was it called? Some big bank like Huntington Bank or something like that, Micron, these companies took forever to surpass their all-time. In fact, these two have yet to go past their all-time highs from 2000. 24 years ago, they haven't hit their all-time highs yet. And guess what? Revenue and profit, several times higher. Revenue and profit, several times higher. Revenue and profit, several times higher. What does this mean? If you overpay for a good thing, it makes it a bad investment. Overpaying for a great story still leads to a bad investment. As a friend of the channel, Professor Aswa says, a story without the numbers is a fairy tale. Numbers without a story is an Excel sheet. Guys, I failed on the story aspect of Tesla years and years ago. I sat there and just focused on the numbers and said, come on, how can they grow this much, this fast, etc.? I was very, very wrong. But there's a lot of great positives about Tesla. One of the things is gross margin. Let me pull that up. Now, the typical car company has somewhere around 15% gross margin. This is Tesla's since 2010. It's averaging probably around this level, 17 or 18%. Not bad. That's pretty good. But that also includes their other forms of business, right? Not just including their car company, the car aspect. They have multiple areas of generating revenue. Mo, why don't you go through that real quick and explain to people how Tesla generates its revenue? Because we hear a lot that Tesla isn't a car company, even though 81% of its revenue comes from cars. We hear it's a tech company. Mo, why don't you recap that for people?
So it's funny. I look at this and 78.5 billion comes from cars. Isn't that interesting, Paul?
Yep, that's the 81%, 82% of the revenue coming from there.
Exactly. And when you come over here, you look at energy and storage, 6.24%, services, 8.6%, Then you look at leasing and regulatory credits. And Paul, I almost take these and just loop them into not necessarily automotive sales, but the automotive piece of the business, because that's what it comes from.
Yep.
It's really, really amazing that people don't call this a car company.
Yeah, so when you look at the leasing and things like that, I look at it going, so it's around 85, mid 80% range comes from auto. And guys, where do I see the tech part of this? Again, here's my analogy. There are a lot of great baseball prospects and football prospects and basketball prospects in high school. Do you call them pro athletes yet? No. Let them go pro first. I will call Tesla a tech company when over 50% of its revenue comes from tech. That's similar to the tech world out there with really, really high gross margins. And this is not high gross margins, Mo.
Right. Their tech is absolutely amazing, but you can't use their tech unless you have the car.
Now, one aspect of it is them opening up their tech to other car manufacturers, which is possible. Look at the charging units. They're doing the charging stations out to people. Now, guys, this is what's so big about this company. You look at this company and you sit there and say, if you're one of those people who bought around here, it's probably scary right now. You're probably like, what am I doing? What's going on with the company? Is it going to zero? Maybe you're not. Maybe you're still sitting there saying, like, listen, I love this company. And that's great. But we've all been, remember, you're not going to buy a company and have it immediately go up. You have to be patient. You have to be able to ignore the market telling you this is the stock price. I'm not going to tell you yet what I think Tesla's worth. To me, that's coming in a few minutes. But right now, I look at this. I was saying it was not worth this back in the day. But if you believe that, and you truly believe it, then why would you not be buying a ton of stock right here? Because the company's better, it has more revenue, has more profit, and all of its other divisions that are higher margin are growing better. So you should love the company even more. But if you're starting to doubt that, I question, hey, if you're doubting this, first off, get in the boat with everybody else. We all doubt things when we see the stock price fall. I doubt my investments sometimes when I see the stock price fall. But what we're trying to teach on this channel, and the reason I want you to subscribe to the channel is because we're trying to teach the fundamental process for buying a company. You're going to buy based on the fundamentals, but the way you're going to make a lot of money is by holding and being patient, and that takes the strong emotional fortitude to do that. Every great investor will tell you, we made money from being patient. We made money for waiting. But remember, the stories that come in and out of the market every day, news follows the stock price. The news on Elon Musk here versus here is night and day difference. Yeah. Night and day difference. He's a villain almost here, and it's getting worse. People don't like Elon as much as they liked him up here. Why? They loved him when the stock was going up. They hate him now. Yeah, I know. He's bought Twitter and blah, blah, blah. But guys, those were all fears here. That's what we talk about, the hype. When the hype is big, when the hype is huge, it's hard to ignore. It's hard to pay attention to the actual flaws of the argument. When the hype is bad and people hate the company, it's hard to see the optimism. And that's why we created the software in the community. I wanted to combine the fundamentals with the emotion. That was super important because I knew that that's how I'd make the most money and make the least amount of emotional mistakes. Investing is a lonely road. When you see these companies fall like this, you're worried, you're by yourself. But the community of thousands of like-minded investors can help you ground yourself to make the right decision. It could be exiting the company. You could have made the wrong decision here, and you're like, listen, I need to get out of this because it's not even worth 165. So if you're interested in making less emotional decisions that'll cost you money, click the link below. $7 for 7 days. And keep in mind, we're going to be adding a waitlist here soon, so go sign up now before the waitlist gets enacted, because the waitlist will have a long wait time. Now, what is Tesla worth? Well, Mo, what are analysts saying about Tesla right now based on our software? Because we get analyst estimates, so what are they saying right now?
Wow. Okay, so December of 2024, end of this year, doing $3.78 per share. End of 2028, $8.09.
That is huge. Over 100% growth. Guys, like I said, 2021, it was making like $1.50 or whatever it was per share, going to $8 a share, and the stock is still down. Go ahead, Mo.
Yeah. $114 billion in revenue by the end of this year, $260 billion at the end of 2028. Wow. Wow is right.
Wow is right. So, what's the company worth to us? Well, let's go to our stock analyzer tool. When was the last time I did Tesla? I'm pulling up my history, typing in Tesla, pull it up. Okay, Mo, I did a 10-year analysis. Oh my gosh, look at my revenue growth assumptions. Low side, I did 10, middle 16%, 20% on the high side. Now, guys, when everybody remember, When people tell me value investors don't care about growth, it's the very first line of our stock analyzer tool. Growth, you can value invest in very fast growing companies. There's no such thing as value versus growth. Value should always be part of your invest. If you're not buying or investing based on value, you're not investing. Value is just about saying, I perceive the value to be $1 today. I want to buy it less than $1. So I did 10, 16, and 20. Mo, what'd you do? Would you agree with this?
8, 12, and 16.
Okay, you went more conservative than me. Now, profit margin. I did 8, 12, and 16 on profit margin. What'd you do?
I did 6, 8, and 10.
No, Mo, I'm giving them credit for becoming more of a tech company here, giving them more profit margin.
That makes sense then.
This is bottom line profit margin. Free cash flow, I did the same, 8, 12, and 16. What'd you do?
I did lower. I went 3, 4, 5.
Oh, wow.
It's been historically lower.
It has been, but their free cash flow is getting a lot better because they have less investments to make as time goes on. So I think over time, it'll equate out.
I do worry though. Elon is kind of like Amazon, where they just keep going. They just keep trying to.
Well, it's worked out for Amazon very well, though.
It sure has. It sure has.
That's what I like about it. Next thing, what's the PE you'll assign to this company in 10 years?
I did 18, 21, and 24.
Okay, I did 15, 20, and 25. For both PE
reasonable.
and price of free cash flow. We're pretty much there. And guys, desired return, I did the market return. So I'm looking at what's the price, what's the value of the company based on if I just want to match the market. This is what I consider to be intrinsic value. Remember, there's no margin of safety here. And we need margin of safety for 3 reasons, according to Seth Klarman. Valuation is an imprecise art. We are human, we make mistakes, and the future is unknown. We have no idea what's going to happen. Who would have thought that it doesn't matter what it is, something will cause there to be a problem? Look at layoffs. Who would have thought Tesla would lay off people? Now, value for Tesla. I hit the analyze button, and this is my market return value, intrinsic value for the company. I have a low price of 57, high price of 355, and it's about where the middle price is now. So I'm looking at going, what margin of safety do I want? Maybe I'm interested at 120 or 100. I don't know. The point is, I don't think it's worth it for me right now. If you buy it today based on these assumptions, you might do okay. Guys, if you're interested in seeing the 33 companies that I want to own forever, watch our next video and don't forget to subscribe at the link below for our community. Take care.